You are listening to the Willpower Podcast. Welcome to the show. I am Will Holdren, and I talk with some of the most influential CEOs, entrepreneurial leaders, and thought leaders to reveal the secrets that have led to their success. I believe that with the right knowledge and mindset, you can do anything you say your mind to. So if you want to learn how to change your life for the better, if you want to learn how millionaires actually became wealthy, or if you want to develop and start your own business from the ground up with the right knowledge to help you, then you are in the right place because this is the Willpower Podcast. How are we doing, everyone? Thank you so much for joining us again today, and I'm happy to be with my co-host again, Rick Segal, and today we're going to be continuing our conversation that we've had the last couple of weeks, which is really revolving around raising capital and how to do it the correct way with investors. And so we're starting to follow back up on that conversation. And we have a special guest we got coming up at the end of this week, actually, which is a guest that Rick is going to be bringing onto her show. We're going to be doing a three-way interview, and her name is Mary Ellen. And she actually has a pretty unique story. So I'm excited to dive into that. But Rick, just starting out, it's been a few weeks. I know I've been sick the last, feels like week and a half, but I'm excited to get back into this. But how have you been for the past few weeks?
Better than you. I've been healthy and making it through the Florida life down here.
That's awesome. And I know we got Mary Ellen coming up. So why don't you provide a little bit of background just for those listening about Mary Ellen, who's going to be on the show in the next couple of days, just so people have a little bit of heads up about what she is or who she is and kind of what she's done.
Mary Ellen Bellevaux is her name, and she started a company. She came out of the healthcare education space. She was writing a curriculum to train doctors and also help them pass their certifications that come up. And she went to a few accelerators. She raised some capital, not enough, and not with the right structure in mind. And her story is interesting because it will show you that it's very difficult to get everything right as an entrepreneur. And one of the things, and we can talk about it now, is you need to really have a roadmap, and you need to have a plan of where you're going to get your next round of capital, what benchmarks you're going to set every time, and what objectives you have. Because fundamentally, if you're running a startup company, you always have one eye on how much cash you have, and the other eye on how you're going to raise it and from whom. So in addition to running your business, you need to keep an eye on those external factors because they are the ones that, as Mary Ellen will tell us, can really trip you up, even when you think you're making progress. Once you don't have money for payroll or to keep the lights on, it's pretty hard to recover from that. So, all of this comes to, it comes back to how you think about the term sheet in the beginning. One of the things that's really important is understanding what your first 2 years of operation are going to look like. Most startup companies, they start with a kind of a friends and family round, which is never really very accurately priced, reflecting, value or future results. It's more of a statement of faith in the entrepreneur who is, known by those individuals to be, smart, productive, serious about what they're trying to accomplish, but um, being untested, and it's a small amount of money. Most of these friends and family rounds are a few $100,000, just enough to get uh, a little bit of a head start on building an MVP, at least something that you can demonstrate to your round of seed investors who will come in next. So at the outset, having friends and family to give you, walking around money to um, help you with some of the startup expense. It may be just, building a deck and getting legal documents. It may be that you've got some external employees, a software engineer that's building something for you. It's very different as we see AI roll out. A lot of that, sort of rudimentary coding can be done by AI if you are particularly comfortable and adept at that. So you can limit that cost. Then when you get to the point of actually having a demo product, a light desk that you can really begin to lay out a thesis, or as people like to say it, especially in the impact space, a theory of change. Um, Once you have that, then you begin to get into more serious thoughts about what can you retain for the founders. There should be a founding group. A solo founder is a lonely position, and also it puts one individual sort of up against the board or the investors all of the time without another set of eyes and ears, which it gives people confidence that there's a team, and also takes a little bit of the pressure off the entrepreneur to have someone who's there who you can kind of do a postmortem and make sure that you both have the same view of the opportunity, the investor you're talking to, whether you're comfortable with them, whether your level of trust is there, whether their level of trust is there, and whether they understand the journey that you're asking them to take with you, what the challenges are, and mostly what the opportunities are. In that case, most most deals these days are somewhere in the $5 to $10 million valuation range when you start out. You may need, capital of 2 to 3 million, which means between the entrepreneur and the friends and family round, you're probably going to still control 2/3 of the company, maybe a little bit more. But you have to think very carefully about how much money you raise and make sure that you lay out benchmarks. You think about, by the time you get out of your seed round, people want to have an understanding of your burn rate, of the product market fit, of the moats that you've been able to develop. And they're going to want to see evidence of a lot of market traction, early adopters, and a path that leads you to have, there is the rule of 80, which is that you've got to have both a combination of your growth rate and your and your margin, you've got to be running at an 80%, total to get to your next level. So you've got to be able to demonstrate that you can be profitable because you have the margin, and you will grow rapidly because you have a pathway to the market. That's when you can begin to think about your A round, which should have the MVP and uh, you should have significant revenues. It used to be that you could get away with a few 100,000. I think it's path now is closer, particularly if you're a SaaS products, software as a service. Uh, Recurring revenues at the $1 million level are kind of what you're going to need to reach, and that is you've got to do two ways. One with a number of different kinds of users, different sizes. You want to be careful not to have a single customer risk. People are going to want to see that there's a diversification, both in size of the customer, length of time that they're willing to commit, and the number of employees that they have, or the number of, how big those customers are, and whether you're looking at institutional size, large scale businesses, smaller and medium businesses. You need to have a bunch of users that suggest what markets you can go into, whether you have internal growth, organic growth within your original contracts, whether you've got a path forward with similar businesses that have similar problems. So it's just a matter of laying out as well as you can a benchmark that when you raise the A, that money will be primarily there for growth and primarily there to get to a point where you are at break even, showing profitable quarters if you can, and that what you need is maybe some more upgrades to your tech stack, but mostly that you just need to have more marketing dollars or more soldiers in the field, because you've got the product, you've got the moat, and you've got the plan.
Yeah. Yeah. So a few things just off of that. One, I think it'll be good to have that conversation with Mary Ellen, just because she's an incredibly smart individual. And, even though you're incredibly smart, it's entrepreneurship and things can happen out of your control. And sometimes things don't always go your way. So I think it'll be really interesting to see that side of the whole coin of entrepreneurship. And I think it's also extremely valuable to learn lessons from people that, have experienced some failures, right? Because they've been through the gauntlet and they know what it takes. Two, it's interesting. I've interviewed a few billionaires on here, and one of the things that they say is most important for people starting out is to be able to play that CFO role in their company, right? And to have that understanding of finance, because as you were mentioning, you got to start out going to friends and family, gain that first initial couple 100,000, get your wheels running, get your wheels turning. And then when you go to your A rounds, it's a whole different ball game, right? And to your point, you got to have a significant amount of revenues, right, to get to that A round of investing and bring in that next level of capital. And I don't think people realize like that, how big of a next step up that is in order to reach that round, right? So
It is, you're right in pointing it out. One of the things that has developed that has been useful is the idea of the outsourced CFO. There's a number of individuals or small companies thought I was going to get struck by lightning there. I don't know if you can hear the thunder in the background. The using a part-time CFO, maybe they've got 2 or 3 companies that they're working on, keeps you always looking professional. I think that nothing is more dispiriting than to be trying to raise money and always get tripped up by not having command of the of your finances, and really having a thorough understanding and an accurate portrayal uh, of those numbers. One of the things that becomes very interesting, particularly when you're in the software world, is the difference between bookings and revenue, and understanding that a lot of when you're at least in the software business, a lot of the bookings that you get, you can't count as revenue because you're not fully delivering. So there's a deferral. That tends to depress the value of your company. So having the ability to understand, what they call rev rec, revenue recognition, and to explain that in a way that makes your company look larger than the reported revenues. All of this goes down to also getting, during those first few years, you want to have customer satisfaction is key. People do want to look at NPS, but more than that, they want to look at renewals. So that also means you better know each and every initial customer you have, know the status, know their problems, give them solutions, work with them, very intentionally, and remember that they're going to be your bread and butter. So you want to, treat them with a lot of respect, even if they're not as quick to pick up how to use the product. You just have to be patient to make sure onboarding and syncing the software solution into whatever the company is using. All of those things really matter. Service, and satisfaction. Those are the same customers that are going to be your references. When you're at your A level, you're going to get, the dreaded customer calls, and you've got to make sure that nobody, everybody's got something that they like to throw that's a little bit negative, but you need to make sure you know where they're coming from and that they're happy with you, or else, make them happy before you start talking to somebody who wants a reference.
Right. It's being aware and taking care of your customers at the end of the day. So jumping back into the whole A round of raising seed capital, there's a couple terms you threw out. One, obviously, a term sheet, and last time we had this conversation, you mentioned the word SAFE, which is a standard agreement for equity, which I think is important to understand for those listening. So if someone's out there going out trying to raise capital from investors, and you've obviously seen it from the VC side of things, but what are the terms that the founder is trying to get this VC to agree to, and what are favorable terms that you've seen?
Yeah, you're asking a good question. So let's go to the SAFE note. This SAFE note, this was something that came out of the accelerator movement, where it was difficult to raise all of the capital that you needed, and at one point in time. When you're starting out, you're trying to juggle expenses, payroll, startup things, with the fact that you can't defer, if you've got somebody who's willing to invest, you probably want to take them in as soon as possible so that you've got that cash flow cushion. So what you tend to do is say to individuals, I will give you this safe, a note that you can convert into equity when we do the next round. Generally, you offer an interest rate on that, maybe 6, maybe 8%, depending on where rates are trending at the time, and then a 20% discount to whatever the valuation of the round is.
Yeah.
One of the challenges with that is you need to think ahead of time where you think you're going to value that round and what are the metrics that will support that valuation. Because as soon as you write down that number that is the target, that's what you're going to be wedded to. People view that as the expectation. Anything less than that is viewed as a down round, which is not what you really want to do out of the gate. So you want to make sure that you have you can put a cap on there that when you give a 20% discount to the safe holders who might come in over the next year, and you might be looking to convert them in a round that's maybe 2 years out. You want to make sure that there's a target out there that will value the company for them at a discount to what the next round will be at. Meaning, the metric, if you want to look at similar companies, what they trade at, whether it's 4x revenues, whether it's 12 times EBITDA, the strength of your IP is another factor, because if you can identify that you have a natural moat and a sequence of investors that need or users that need your product, that will show itself in a high growth rate and also, solid margins. So you just, when you do the safe, you want to make sure, as I said, that it is not so high that people don't believe you'll get there, but not so low as to guide people, give people the sense that they can invest in your company at a lower valuation, which will only end up in diluting you as the founding shareholder and your team, the value of the options, all of that. So usually that is a $10 million valuation from your early investors, whether it's seed or friends and family, giving them a discount, giving them an interest rate, and working towards always being able to get that paid down and converted into a preferred stock as soon as you can, build the case that your company is worth at least $10 million.
Yeah. Now, who comes up with that valuation? Is that just the founder making an educated guess, or is that hiring a professional valuation team to come in, look at revenues and EBITDA and give you a number?
No, I think it is, it's a combination. In the beginning, when you're working with those seed investors, very rarely will they give you a term sheet. And when you're working with the A investors, very rarely will you give them a term sheet. But you have to have a sense of the market. I mean, one of the things that most, entrepreneurs do take advantage of is going to some of these conferences, maybe going to an accelerator, meeting other, entrepreneurs, sharing stories about uh, how you valued your company, what pushback you got, um, and how should you think about valuation? How did your peers think about it? What lessons did they learn? It's you really don't want to index on the highest price you can get. You want to index on the strongest partners you can get so that they will be there. They've got dry powder to help you in the next round. Most people that come into an A round want to see some participation from the original investors. So you want to make sure that they are allies and that they do have pockets deep enough to show a continuing level of support, even if it's pulling back from where they invested, the amount they invested.
Okay. So they got to see some commitment going all the way through from the original investors to the A round to the following rounds.
Usually what happens is the initial investors give the A round investors confidence. You do want to negotiate for those um, the right to participate in the next round so that you do have the opportunity to increase your position if you like it. So you want to make sure that you're giving those investors participation rights that will keep them around the table, especially if you deliver for them. But after you do the A round, the next level of investor is not going to be looking for the seed level to keep participating. They can if they want, but they do want to know that the last guys in want to keep going. So you kind of have to build in that way.
Okay, got it. So how does the term sheet technically differ from the safe sheet you were talking about earlier?
Yeah, what you're talking about is a safe was just designed because it starts out a simple agreement, and the idea behind that is that it is only debt, so you don't begin to negotiate blocking rights on how much money you can borrow, whether you can put more debt on the company ahead or behind. It's just simply that you've got a note to the company that you will convert. When you get to a term sheet, that's when it will become a purchase and sale agreement. It will define who the board is, what if any blocking rights there are. A lot of people at the seed level will want to make sure that the company can't be sold out from under them. So it might be you start negotiating things like unless I give you a 2x, I can't sell it, within 3 years. Things like that, just to make sure that no investor wants to do a lot of work for a small return. So you've got to keep the momentum on the upside available, and not um, you know make people believe that they want to take a longer ride with you, and not that you're in there to take a quick turn and make some money and go home. Those guys really, the dream of a seed investor is not to make one or two times their money and have a nice time. They want to know that there is a multiple on the upside that will reward them for taking the risk that they've taken.
Yeah. And when they're talking with the founders, man, are they looking for interest on their capital they put into it at that stage, or are they really just wanting the preferred shares?
Usually, what they do is nobody takes out interest on the note. You can take the accrued interest and roll that into more shares. That's usually what's going to happen.
Okay, got it. Yeah, so there's definitely a lot that goes into that. And as a founder, I mean, how many people tend to jump into these investments during like the A round or B round or following rounds? How many people are you trying to reach out to?
You know, it, this also changes with the times. And right now, we're at a point where there's not a lot of people that are still excited about early stage investing. The 23, 24, and 25 have not been really good for early stage investors, mostly because companies, you and I think, have talked about this before. A lot of the standard institutions that were there to give startup companies growth capital, and I'm talking about whether it's First Republic or SVB, a lot of those lenders disappeared, went out of business. That had the effect of making it harder to get capital when you needed it, which meant that a lot of early investors were getting squeezed. They were getting crammed down, and they were seeing that the company, in order to attract new capital, had to give away things, as I've said to you before, like a 2x or 3x or participating preferred, things that make it very difficult for the early stage capital to actually thrive and survive, maintain their capital position. When you do these rounds, obviously the management, if they're able to get somebody in, they're in control, because new investors are not looking at who the seed investors are. They're looking at the management. They want to make sure that they're incented. They want to make sure that they see a path to compensation, which includes both cash and options. And if you're squeezing at the top and pushing from the bottom, that's why we've got these seed investors who are disappearing. It's been a learning lesson. When everybody was making money very quickly and rounds were being done at higher and higher rates, those investors were always happy.
Yeah.
When things get tough, they're also the first investors to be squeezed, which is kind of ironic because they are the ones that have been most loyal to the management. But that is the reality of it.
Yeah. So it just ebbs and flows as the environment changes, obviously, with that.
I think we're seeing right now another one of these crazy times. Right now, anything that says AI is all of the capital is going to any company that has AI in its name. And the valuations for AI are, really off the board, off the charts. It can make you wonder about the valuation you're putting on your company If it's not, every company that uses AI today, every citizen uses AI. So
Right.
it's not enough to say, yeah, we use AI. If you have AI, it's got to be uh, part of delivering a better outcome, not simplifying the process. Um, and if you have a unique take on AI and approach to a market, as we're seeing, those valuations can be quite high. Uh, but there is a ton of risk, in that, and you're really getting larger checks from venture firms that have a deep enough pocket to take a position in an AI company and lose all of that money because they know if they take 4 or 5 similar shots, a few of them will do really well, just like when the dot-com boom, happened. Once in a while you got Snapchat, and once in a while you got MySpace. It
Right.
just it happens.
Yeah. Yeah, it's gonna be interesting to look ahead 10 years to see, which AI companies are the ones that made it out, but obviously no one has a crystal ball. So it's kind of like you mentioned, getting in a bunch of them and seeing which ones are gonna make it out.
Yeah, and I think it's, as I said, if you're providing, if you're using AI in a way that fundamentally changes the way that product works, and the value of it, not just, as I said, simplifying steps, but actually doing things that the human is not capable of doing. And I'll give you a simple example. Um, AI looking at a CAT scan that has the ability to pick up patterns that no physician can pick up. They're just too many multiple inputs. So AI can help a physician make a better diagnosis, not a faster diagnosis, but a better diagnosis because it sees something that the physician might miss. Not that you want the physician to cede the decision to AI, but it will alert the physician to things he hadn't noticed because there was too much data. And that's where AI makes a real difference. And we're seeing that in the way it's being used um, in teaching settings, giving both the student and the teacher feedback that they would never be able to get no matter how much time they had on task.
Yeah.
So so AI, we don't know where it's going to go to. Um, we do know that it is evolving incredibly quickly, and when that happens, you know that there's a shakeout coming.
Yeah, it's definitely gonna be here to stay. Um, and
Yes.
we're gonna definitely pick up on this in our next conversation as well. But before we hop off today, is there anything else that you'd like to say?
Uh, no, I think I look forward to having some more conversations, and I think that bringing in some, I know that you've had a couple AI practitioners, but I think spending time with some entrepreneurs that have used AI in creative and defensible ways maybe will set uh, a bit of a roadmap for what really makes an exceptional offering, what will get somebody's attention. Because I guarantee you, there are 25 decks on anyone you talk to's desk right now. You haven't seen them, but you're talking to somebody who is going to be comparing you to a lot of offerings. You better have a story that is, defensible, unique, and you know, it, an exciting demo.
Yeah. Yep. A lot of opportunity out there. But all right, guys, there you have it. Rick Segal, thank you for hopping on again today.
All right, great to see you, Will. We'll talk soon.